Hello, and welcome to today's KraneShares webinar, our 2026 Outlook and Q4 update, 5-year plan, pro-profit policy, and new listings. My name is Brendan Ahern. I'm the Chief Investment Officer here at KraneShares Exchange Traded Funds. I'm joined by my London-based colleague, Dr. Xiaolin Chen, our Head of International. I certainly want to thank all of you for joining us today. Since January of 2024, Chinese equities have been rallying. Now, we've seen a slight pause in that rally as we entered into the new year, but we're very constructive on Chinese equities for 2026 as this re-rating of Chinese stocks as global investors come back into the space. So today we want to provide an overview, some insights into what do we believe the current catalysts are, review some of the risks that are out there, as well as providing our perspective on U.S.-China geopolitical relations. For those of you looking for continuing education credits for CFP, CIMA, and CPD, please email us at ce@kraneshares.com. That's Charlie Edward at kraneshares.com. Certainly, Xiaolin and I would love to entertain any questions. Please don't hesitate to submit those questions over the course of the presentation. If you're joining us on kraneshares.com, please email us at info@kraneshares.com. If you're joining us on Zoom, please use the Q&A button. All right, for those of you, let's dive right in. For those of you less familiar with KraneShares, our founder, Jonathan Crane, moved to China in 2001, where he built a business geared to China's growing urban middle class and the adoption of mobile technologies. Now, living in Shanghai, Jonathan experienced firsthand how China's economy was evolving away from export-driven manufacturing to include new China economic sectors such as the internet, e-commerce, mobile payments, healthcare, clean technology. All of these new sectors were really where the Chinese government policy, as well as investor interests were being focused. And yet, if one looked at the exposure of the definition of China, or China's exposure within broader emerging markets, it was all old China. It was all financials and energy companies with little to de minimis exposure to these new China thematics. That led to Jonathan creating KraneShares, a firm focused on China's growth sectors back in 2013. And on the next slide, you'll see that our product suite has evolved to include trends that we've seen in China that we believe will go global, such as our recently listed KWEB, our humanoid and embodied intelligence ETF. Certainly, our global electric vehicle ETF was based on our experience in seeing Tesla's success in China back in 2017. Also, I think the most important thing that we try to provide investors when it comes to China, but all of our products, is a balanced, data-driven perspective. So we publish our ChinaLastNight.com research to provide you a balanced perspective on what happened in China. But certainly when it comes to, say, our pioneering efforts in investing in global carbon credit allowance markets, our colleague Luke Oliver runs that franchise and provides really the preeminent expert in that field today, as well as we've listed exchange traded funds on behalf of partners that we have a strong conviction in, partners such as Mount Lucas with their managed futures strategy, Hedgeye Research with their volatility adjusted U.S. equity exposure, as well as firms like Man Group, the largest hedge fund manager, publicly traded hedge fund manager globally, and their bio strategy. But let's dive into what's happening with China. I think one of the things that I spoke about, Jonathan's emphasis on the growth of these new drivers within China. And again, we want to take a data-driven perspective. So I know the narrative out there is that Chinese equities have been in this multi-decade bear market. But that's not true if we peel the onion a little bit. So since the global financial crisis, the S&P 500 is up 1,278%. And yes, it's true, MSCI China is only up 272%. But here's the key, is that definition of China was really just financials and energy stocks. And so if we look at a growth sector within China, let's see what the results were. So technology is obviously a growth sector. So what did MSCI China Technology do over the last 17 years? It went up 3,257%. Now, I'm glad you're sitting down, Jalen, because you wouldn't believe that technology back then, going back to the globe, was only 2% of the index. Only 2%. And that literally is why we created KraneShares, is to take out that growth factor for China and provide it to investors. And lo and behold, you actually did well more than doubled the performance. And that's why we created KWEB. This is true for emerging markets, by the way, that emerging markets is only up 388%. But if you look at EM Tech, it went up 2,196%. And that's literally why we created KEMQ, our EM version of KWEB, and one of the absolute top performers over the last 2 years, according to Morningstar, one of the top performers amongst emerging market ETFs for the last 2 years. Now, part of what's driving this is the strong performance of Chinese equities. Now, on the next slide, what we want to show is that you have really two Chinas. You have onshore China, so that's the Shanghai and Shenzhen market, predominantly owned by investors in China. And we'd highlight that a lot of these growth companies are listing on the China's Star Board. So you can see K-Star, one of the top performers last year. And then obviously you have offshore China. So that's the predominant definition of China for global investors, and some very solid returns last year, outpacing the S&P 500. But you can actually see how it lagged a little bit versus onshore China. And I really do believe that what KWEB, that growth factor for China, if you think about onshore China, K-Star is that growth factor for onshore China. So we're doing a lot of work on how K-Star does versus mainland indices such as the CSI 300 or even the CSI 1000. And again, we think there's a really interesting opportunities there. Now, on the next slide, I think part of what investors are they're starting to see this outperformance of Chinese equities. And again, this rally did not start in January of 2025 with DeepSeek. It started a year before when you had this equity derivative induced meltdown in China. And we hit that bottom in mid-January of 2024. And we've had this slow and steady grinding higher, this bull market. And I really just think it's a matter of investors saying there's more out there than just US equities. And so that's part of our re-rating thesis. And I think on the next slide, the real key is like, what is the upside? Did I miss the opportunity? I don't believe so at all. And we can see that, US markets really, really close to all-time highs. And yet at the same time, KWEB is well below its all-time high. And again, we think this is part of that re-rating thesis of simply investors looking to buy low, sell high. And if you're rebalancing what's really worked, within US equities, I think a lot of that money, an element of that money is going to get put to work in Chinese growth stocks, and we really do believe there's a upside potential there. Now, I think one of the challenges in China that is really weighed on the economy has been the real estate sector, and the real estate sector is very key because it's obviously construction employs a lot of people, plumbers, electricians, cement mixers, and yet new real estate sales supports home furnishings, home appliances, but also because of the incredible migration into Chinese cities over the last 50 years, that 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 made real estate really a one-way trade, and it became a very, very significant amount of household savings. The estimates are up to two-thirds of urban household wealth. It's been invested in housing, and the government knows that they really wanted to see that money go into the things that China needs in the decades to come. And so the government tapped the brakes on the real estate sector. You saw that with over-levered real estate developers, the Evergrandes and Sunaks and Country Gardens running into problems, but also the knock-on effect of prices coming down led to very low consumer confidence and domestic consumption. And we're starting to see a bit of a policy pivot to stop these prices from going down from the government, and try to restore that consumer confidence. And Xiaolin, as I hand things off to you, we continue to see just even overnight. I mean, the MIIT spoke at length about domestic consumption. Yesterday, it was the Ministry of Finance. But I think on the next slide, we've seen this with the 5-year plan. So I'll hand things off. Just certainly the draft of the 15th 5-year plan, and what are the really important things for investors to take note?
Yeah, Brandon, I think at the end of the day, policy really directions is very important in Chinese market. That's why I think repeatedly you and I have kept the audience up to date with all the policy directions and the areas that get touched based in any policy meetings that's announced by China all the time. I think if you read CNN today, you see all the updates of how they committed or remain very committed to help on the consumer side. To how they're going to help the consumption. You mentioned the real estate market early on on the previous page. Is a classic example to share with the audience here is the nation realizing that they can no longer just rely on real estate market to continue to grow the economy and generate the wealth in that way, as they have done for a decade. This consolidation is probably the longest in history, but bear in mind, it didn't have a commercial real estate since 1990s. So it was like 2 decades, 25 years, 30 years at the most, that they have this commercial real estate market. Means you can freely trade the real estates for private use, company use in all aspects. This is a very long consolidation happened. It does impact household mark to market. 2 or 3 years, I believe the dust is nearly done there. Obviously, you still see a bit of seasonal adjusted in December, that the pricing continue to fall, but that's just seasonal. Okay, it's December. 1/3, if not 2/3 of the nation is under winter time below zero. If you're desperate to move house, then you move house, and then you desperate to sell, you sell at a discount. Is the like the time of the year, like I live in London, in the UK, just no one move house at Christmas time. And if you really do, then it's like huge discount. So anyway, so I think that consolidation is near bottoming. You will see a bit of hiccup from here and there, but the massive corrections are done. And then looking at 15's 5-year plan is every 5 year the government make a plan for what the nation is aiming to achieve, what's the direction they try to focus on, so on and so forth. This is the one that we used them in the past, but we want to just remind the audience again, this happened in October when they first released this 15th 5-year plan. This is eligible for 2026 and all the way to 2030, that 5-year of the plan. A lot of the area doesn't come as a surprise. They want to help consumption, they want to help urbanizing the society, modernizing the infrastructure, if not manufacturing hub, the entire ecosystem chain, so on and so forth they have. And if you go to the next page, you have some highlights. I think if you read through all the documents, you find what we said here is one or two things in common is they want to help with the people, the consumer, the consumption, how they're going to create and generate more wealth for the household. Yes, certain consolidations needed, and they have done that. And going forward, how they're going to focus on growing this economy, make sure it's continue to show resiliency with all the uncertainties the country face externally. I think it's particularly interesting to see December's data as finally formalizing that the economy is very resilient. The economy continues to grow. Exports up 6.6%, auto exports up 71%, chip exports up 48%. They recorded the whole year of 2025 of a trade surplus 1.2 trillion. All-time high. So you can see they have, as a government, they have been naming a policy in a way that they can help the economy to be a little bit independent to the uncertainties, external uncertainties, focus on domestic growth. And this is a country that have a complete ecosystem, complete supply chain. Namely, they can manufacture from A to Z. They also have customer to consume domestically. So this is where I think we've been saying that the policy is realistic and it can be delivered in a way if they manage them well, on focusing on consumption, on focusing on technology. Technology comes up almost at every single conference you attended in China last year. I think continue to be the case. If you attended CES, which I think Joe Duby, our global head of marketing, was in Las Vegas a few days back with Zhang, you will see how Chinese firms were presented there at CES. Okay, there's over 4,000 firms. I heard it's probably 1/3 or more than 1/3 are from China. You can see how the companies are preparing themselves and continue to align with the government's policy, package to help them and accommodate them to grow in the technology front. So policy, long story short, consumer consumption front and center is what the government focus on, either by lowering the cost, continue to help the corporate households to borrowing on credit. Corporate credits picked up quite nicely last year. We still need to see household credits to pick up like the corporates. Just the trend to start to pick up is a great confirmation that business are continue to doing well and technology. And in reaction to the technology, if you go to the next page, is always what we do. Like, our KWEB fund, KWEB fund really well. That's our flagship ETF. It's playing the consumer play. It is playing the consumer power. It's also playing the key players, the dominate. If you can think of China's technology development landscape, those names in KWEB are the big brothers and sisters, have a very solid line of revenue that they can continue to grow their business and very reliable revenues and incomes. And at the same time, they are leading for technology development. They are leading for AI. They are leading for the next wave of, innovation technology. So like Alibaba announced 53 billion investments in AI last year, which they already started manufacturing their own chip. And additionally, like the the Minimax, you read Brandon's notes, you notice that is the large language model that did IPO in Hong Kong, that Alibaba owned 14% of that company. So by owning KWEB, you're literally owning the healthy part of the technology company in China, the reliable company that generates a great source of income continuously, and at the same time, they're leading and driving for the next wave of technology developments. And we launched this fund called KWEB. This is really also in reaction or in the way of offering investors to capture what are the true AIs that generating you the most commercializing opportunity. If you look at the CES and social posts anywhere you like, is this year you heard Jason Huang saying at CES that physical AI, I know physical AI is not just the robotics, but physical AI does require the AI to have a massive data and be able to react and commercialize, use them in the real physical world. And which is the country has the most data centered and be able to ready for the AI company to develop on top is China. And the ones that may be able to easily, or not easily, but at least converting that capability in the real physical world are the humanoid robotics AI in the whole entire ecosystem. So we launched KWEB. This fund is available in the United States. It's also launched in UC's world, really in reacting to the 15th five-year plan of China to continue to lead in technology, at the same time aiming for the next tier of the AI is to the usage to commercialize this AI technology. KWEB have 35% in China, the rest is in the rest of the world. 20-25% in the United States, and the rest is in Germany, Japan, and other countries as to follow. If you go to the next page, I just want to highlight one more thing, is this is the economic work conference group. Every time they host them in December. We have the anti-evolution, have slightly different orders on my deck to this deck. But this is also an important page. China has been facing quite a prolonged period of time of dealing with inflation, purely because the deflation, not be able to trend up with the economy trying to pick up, and the inflation continue to be a problem. The governments announced this anti-evolution, means stop just compete with each other, literally managing the pricing floor and produce the more competitive advantage over to each other. So this was more encouraging in a way that helped to set a floor on pricing in terms of to remove or avoid unhealthy of competition in price. However, I do think some of the industries does present to be a bit of a more players than needed. So certain level of consolidation are required in certain industry in that extent. This policy will definitely allows markets to consolidate. One, second, also setting a floor for the price and potentially created or provided a healthy environment for next wave of competition in a healthy way. If you go to the next page, please. Obviously, with everything happened in China, with the policy set up front, with the heavily dealt or heavily encouraged policy to deal with, real estate issue to help the household to continue to generate wealth. There's a lot of package, a lot of announcements announced to help the household. Also, Chinese, household individually, they still have, in the past, traditionally have a bit of a heavy loaded of their financial assets in real estate. Over the last 2 or 3 years, because of the consolidation happened in real estate market, they have been looking on the individual household, has been looking alternative source for investments opportunities elsewhere. A couple of issues happened and developed, I'd say, was a issue, you could call them that, but in the other rounds, in the other way, they actually created opportunities for investors, namely, some of the companies now looking for alternative listing from not just listed in US, but also back home to list it in Hong Kong, back home to list them here as a dual primary listing or secondary listing. That actually opens up the table opens up the opportunity for some of the stocks become connectable. What does the connectable do is to allow investor ownership onshore in China to buy those stocks without the quota restrictions. So this page we really just showed year over year how the mainland investor actually purchased, the Hong Kong listed, means from mainland to more of the you call them offshore stocks listed in Hong Kong, stocks and ETF. So they call them SOS, stocks, southbound stocks connect. It just shows a record high year of 2025. That's mainland investor has invested over 180 billion into Hong Kong stock. This is partly due to they're looking for alternative investments to diversify away their financial assets. Obviously, also to take more opportunities now become available that wasn't available in the past. If we go to the next page. This is obviously a page that I think Brandon also mentioned he's selling from time to time, and we like to highlight is also our China's, all these China internet firms, particularly these firms that are sit in our KWEB funds of these names, how they have been dealing with the situation, particularly during the challenging time after pandemic reopens, is they're trying to grow their business back, trying to generate revenue, which that's completely behind them already, behind the past discussion, how these Chinese firms has been really focusing on generate very healthy cash models, allowing them to invest into the new investment opportunity. Like I mentioned earlier on, Ali was making 50+ billion available to invest in AI. This is partly due to their very healthy cash flows on their balance sheets. That's one. Also, they have been trying very hard to show the investor that we care our company, we believe in our company, and we're generating more of the value for our shareholders. Some of them even not only distribute dividends, which they rarely do in the past, and if you compare that to their U.S. counterparts, obviously Chinese firm are slightly at the higher end. And the buyback, I have to say, this is actually a very important step for investors that invest in this company in the long term, to say, you know what, the company themselves believe in their own value and their own futures by buying the shares back. I think these are just some of the slides to show, one, on policy, second, what are the trends and themes may actually align with the policy that investors can invest along the mega trends happening in the markets today, together with our solutions that offer you a bit of a diversified approach like a KWEB, and also a bit of a closer look on, is Chinese mainland investor investing in their own stock? The answer is yes. And are these Chinese companies trying to generate more shareholder value for our investors? The answer is also yes. I'd like to pause here. And Brandon, do you want to touch base on a bit of the forecast?
Yeah, certainly. I think we're headed into the Q4 earnings season, and so we're really want to see, what on the buybacks, are those programs extended? To what extent have the companies been buying back shares? The companies that are listed in Hong Kong, they have to file on a daily basis. So I think it's important to understand that Chinese investors are buying the growth stocks we hold in KWEB, and that's mainland investors via southbound stock connect buying those shares. Today, 1.7 billion US purchased of Hong Kong stocks and ETFs. Nice net buy in Alibaba, as well as you're seeing the entrepreneurs, the founders of the KWEB companies. They recognize that they believe their stock is cheap, and I think on the next slide, how cheap are these securities? Well, just in comparing, what has revenue done over the last 4 years versus the stock price, and for compliance purposes, we have to show the top 10. But if we went below this top 10, some of the numbers are even more dramatic, where you have companies that you're talking about are off very, very significantly. So we really do think that this just shows why are the founders, the founder of Tencent, Pony Ma, why are they buying back stock? Why is Joe Tsai and Michael Evans, why are the management a lot of those original members of Alibaba's management team, why are they buying back stock? Robin Lee, Robin Liu, JD, Baidu, so across the board, we're seeing this buying, and I think they just believe their stock is cheap. Now, on the next slide, um, I think one of the thesis that we're trying to make that Jialin highlighted was that the Chinese are buying China, and we're starting to see a little bit of a rebalancing effect from investors globally back into the space. And I think something that Jialin and our colleagues in Europe experience daily is that the dollar's weakness has become a real headwind on investing in U.S. equities. And certainly in 2025, if you are a euro or Swiss franc or Swedish or Norwegian krona denominated investor, you weren't up 18% in U.S. equities. And so that headwind makes other markets look very appealing. And certainly from Europe, we saw money come out of that rebalancing. Yes, European markets had a good year last year, but on the next slide, an element of that money that came back out of Europe went into our space. And I think what's interesting here is why were these European investors so much more likely to invest in Chinese equities? That the European ETF market is about 3 trillion versus the US market is 13 trillion. So why would a CFA or MBA in Europe be more likely to be investing in Chinese stocks? And I think an element of that is the geopolitical, that the media narrative in the United States is exceedingly negative. And that's why we write ChinaLastNight.com every day. Would you know that the MIIT spoke at length about the importance of humanoid robotics unless you read today's China Last Night? Because it's not in the Wall Street Journal, it's not on Bloomberg News, it's not in the Financial Times, it's not in Reuters. And so we want to highlight what we're seeing happening through the China Last Night. And I think this is an example of why US investors have been a little bit slower, this perpetually negative media narrative. And we can actually quantify what the effect of this on that, if we look at China's weight within global indices. And on the next slide, we highlight that despite, and I find this so fascinating, Jalen, in 2025, China's GDP hit an all-time high.
Yeah.
But did you see anywhere China's economy has never been larger than today? Like, that's not what we get. And so again, we've seen that, yes, China, we had some policy errors. If it's zero COVID, what's happened with real estate, that, some of the internet regulation, we've seen that weigh on investors, and they're starting to come back. But how do we quantify what that re-rating would look like? And we can see, well, China's weight's really off its all-time high within global indices, which that's the upside. That is literally the upside potential. And on the next slide, this is looking at actively managed global mutual funds. So this is for European mutual funds, US mutual funds. How much China do we own? And I think you see, yes, on the left side, you see these global managers are slowly coming back into the space, but relative to where they were, a significant way to go. And in fact, 20% of funds that are benchmarked to the global benchmark, all country world, 20% of them hold zero China. I
That's
mean,
a painful trade, Brendan.
what's that? I'm sorry.
That's a very painful trade for them last year.
I would think it's career risk.
I would
How,
say
how do you,
it's
we're
not
talking
money.
about Jalen, we're talking about how great, this equity performance has been, and 20% of them have zero China. I mean, it's ridiculous. But I think it's now on the next slide, we show these are actively managed emerging market funds. And we can see that EM managers can't not hold China because it's such a big part of the benchmark.
Mm,
And yet they're still significantly underweight China. And yes, I mean some markets, South Korea had a very, very good year last year, really driven by two stocks. Samsung XK Hynix, very similar to what we see in Taiwan, where TSMC is literally why we created KEMQ to be able to own those names. But again, we would argue this is a lot of money that's not participated in the trade. On the next slide, JP Morgan holds semi-annually, they hold a conference around the IMF and World Bank meetings in Washington, D.C. And then they actually poll the several hundred institutional investors at the conference. They ask them how much U.S. equities, European, how much Bitcoin. It's a very, very in-depth survey to understand what's the consensus thinking from these institutional investors, and it's shocking that 41%
mm,
of these investors have zero China. Another 35% are underweight China. And I think a key factor here is that a lot of these institutions, if it's pensions, foundations, endowments here in the US, they have to have the consent of their trustees, their board of directors on where they're investing. And I think that's where this media narrative has been so negative. It's very hard to get that approval. And again, I think this is the bottom, the trough.
mm,
Because again, on the next slide, you have this grind higher. That Chinese equities bottomed back in Jan of 2024, and we've had this market that's within, this is called an uptrend, higher highs and higher lows. And investors, it might feel like two steps forward, two steps back, but it really is two step forward, one step back, two step forward. So this grind higher, I think it's key investors to recognize that this uptrend is in place. And on the next slide, I think one of the things we as investors want to ensure is that you have to be a little careful on. We don't want to come in at those highs. You actually can come in at the lows, and so one of the things we've done is looked at the relative strength index. So this is kind of like a momentum factor when we apply it to KWEB, and it allows you to time your rebalancing. That one of my favorite investors in KWEB today is a U.S. institution that they always hold KWEB. But they actively rebalance it because they say we want to be able to take advantage of these peaks, that rebalance from the peak, and then buy more at the bottom, right? At those troughs, and rebalance. So they're actively rebalancing the KWEB. They're not saying, I know this is the bottom or I know this is the top. They'd say, no, that's impossible. That's market
mm,
timing.
mm,
But they're actively rebalancing that. And we've tried to highlight this through using the RSI as that potential signal an investor can use to try to say, okay, here's a good place to maybe add to my position. If I get a big run, I can take a little profit, or potentially take advantage of some of the derivatives around the KWEB on the U.S. side. Something that hopefully we get going in Europe. That's coming. But anyway, and again, so we can monetize that volatility now. Now on the next slide, I think one of the things that, in terms of our forecast, I think one of the things we see coming is, to your point, we had Minimax.
Mm.
It's Knowledge Atlas, which people call Zhipu. These are AI, very much AI companies, but I think something that a lot of investors don't really see is this capital markets activity in Hong Kong has really, really changed over the last 2 years. The most heavily traded company in Hong Kong would trade about 5 billion. And now it's three times that. If you look at Alibaba or Tencent. And so this animal spirits is coming back. We see that in volumes in Hong Kong. We see it in the IPOs,
Mm.
really, really strong. And then to your point, Jalen, on South Korea and Japan get a lot of kudos for being more shareholder friendly, but we see companies like Tencent, Alibaba spinning off holdings, and we anticipate Baidu is going to, they've said they're going to spin off their AI chip unit, Kunlun, in a Hong Kong IPO. You showed that slide of all of that money that came into Hong Kong from mainland China. But there's a host of companies are not available. They haven't made themselves available for southbound stock connect, and we anticipate that's a strong catalyst for companies like Baidu and JD and NetEase to make themselves available, like Alibaba and Tencent are today, or Kwashu was a big
Once
net
they
buy.
become connectable, Brandon, they opens up for free quota trade on mainland, do they? And how quickly you think that can happen?
So they have to, now, why would they not want that? Well, the SFC is a very strict regulator. The SFC had a huge fine for a company today. So the SFC is a very strict regulator. There's a lot that goes along with having this dual primary listing. That explains why some companies have been a little bit slower to come back. But I think these companies, not just for the founders' net worth, but I think that happens by the end of this year. That there's kind of two windows to become available for Connect. So if they don't make the kind of spring inclusion, that kind of pushes it to a fall inclusion. That's a huge catalyst if I'm the founder and CEO or chairperson of one of these companies. If I'm an employee, I want my company, because these are tech companies. The employees are getting ESOP, right? Employee stock options. So there's lots of incentives for these companies to get in there. So if not in the spring, um, definitely, hopefully by the fall, huge incentive. Now I think on the next slide, I think the most important catalyst we see out there is an improvement in U.S.-China relations, and that's something that we don't believe the market is properly discounting. That I think the market is very focused on, the 15th five-year plan, its emphasis on domestic consumption and technology self-reliance, this MMIT conference today on humanoid robotics, but they spoke about domestic consumption, AI plus manufacturing. But I really do think that you see President Trump I really do believe wants to see better U.S.-China relations. That part of the Monroe Doctrine is more focused on the Americas, and I think some of this Greenland is nothing more than a pawn to try to cajole or force the EU to concede on a Ukraine peace deal. That's a lot of rumors out there, but I think also President Trump, as a business person, has his ear to U.S. corporate interests, and U.S. corporations have a lot of interest in China, and I think you'll see, even overnight, Secretary Treasury Secretary Bessent said he spoke with Vice Premier Hay. You had U.S. Trade Representative Greer say that the U.S. and China should do another trade summit before Trump and Xi meet in April. And I think if you have better U.S.-China relations, that means better U.S.-China headlines, and that would dissipate some of this geopolitical, some of this media headlines, and I don't think the market is at all anticipating what we believe, which could be three Trump Xi meetings in 2026. April, um, President Xi said he would visit President Trump in the United States over the summer, and then you have the APEC conference in Shenzhen this fall. So again, I think you have this has been a huge headwind for U.S. institutions to invest in China. This geopolitical, this media narrative. The one investor that is unencumbered is hedge funds. Hedge funds want to make money. So you see a lot of US hedge funds are back in the China trade, and that's because they don't have a board of trustees, they don't have an investment committee, they don't have a board of directors. They just want to make money, and so they're very quick to come back in. So net, to conclude, there's a lot of positives we're seeing. China's economy all-time high. Um, from a GDP perspective. But we also see, as students of China, and on the next slide, we kind of highlight that, this 15th five-year plan, that draft, it's really one of the key reasons, John Crane created KraneShares, was that in living in China, he saw the importance of understanding the five-year plan, and this draft of the 15th five-year plan, it heavily speaks to domestic consumption, technology self-reliance.
Mm.
And we as investors want to be in front of that trend. So we think KWEB is so well positioned just on the domestic consumption, through the e-commerce space, but also a lot of the KWEB companies, if it's Alibaba and Baidu and Tencent, very critical players in the AI and cloud computing. And then we really do believe that the US and China can have better relations under President Trump, something that wasn't feasible under the previous administration. And so this re-rating of Chinese equities is an ongoing process. And that's what makes us very constructive on the space. Now certainly, again, we'll go through some compliance slides. But for those of you who have questions, please submit either by emailing us at info@kraneshares.com, or if you're joining us on the Zoom, please use your Q&A button. If you'd like to receive this presentation, please email us or your KraneShares representative, either at info@kraneshares.com, or just email your contact here, and we can get you this presentation, of course. If you wake up tomorrow and say, man, gosh, I wanted to ask this, we're always available. As well as, obviously, you can stay on top of the very fluid situation we're seeing with China via the ChinaLastNight.com blog, but certainly Xiaolin's team in Europe, our colleagues here in the US and in Asia are always available. But yeah, let's dive in. Any questions jump out to you, Xiaolin, that
Uh, few housekeeping items, like you said, just answer the question. One gentleman asked if the webinar would be recorded and available. I think the answer is yes, right?
of course.
Yeah, we will record it and we'll make the recording available. So that is a good one. And Bruno asked a question: with the economic recovery and more stable China market, and with China opening up, how do you see the incremental inclusion of China A shares into their global standard index? I think that this is a good question. This has been paused for a period. What's your thoughts, Brendan?
Yeah, 100%. And goes back to these two Chinas that you have onshore China, um, really comprised of Shanghai, Shenzhen, second largest stock market in the world, but historically had capital controls, more difficult to access. That changed with with the advent of Stock Connect trading back 2014, 2015, and that allowed MSCI to add
Mm,
the Shanghai Shenzhen stocks starting in 2018, 2019. They started a partial inclusion. That inclusion was stopped because of the geopolitical. Now, so Chinese A shares should be about half of the exposure of MSCI China, but they're only 15%. So I think, you know, if this if you believe in President Trump, President Xi improving US-China relations, potentially that leads to an MSCI including or reestablishing this inclusion. I think that could happen. That would require a consultation, which could take almost up to a year. So it's not going to
mhm.
happen overnight. But I do think that's a consequence of better U.S.-China relations. We know China's weight should be 50% higher because the MSCI is excluded the second largest stock exchange in the world. That the definition is really Hong Kong and U.S. ADRs, and they've only included 20% of the potential market cap of these Chinese A shares. I really do believe, kind of akin to this, that as an investor, maybe you don't want to wait for MSCI, and we give you those tools through our MSCI China A. In Europe, we have the S&P China 500. But also, do think, Xiaolin, the starboard, if we think about, what KWEB kind of did to MSCI China, like, right, giving you this growth factor, K-Star gives that to you for onshore China.
Yeah.
And yeah, I mean, listen, I think K-Star, I looked earlier, as a shareholder, was up about 5% today. But that's where a lot of these growth names that we're seeing taking place.
K-Star is really unique. It's China's own Nasdaq, and it's all these amazing Chinese-owned unicorns that chose to list onshore. You wouldn't otherwise get an access to these names. That is already very healthy and dominate in certain sectors, industries. And Star, I believe we're the only one who have license to that index anyway in the United States and in Europe. So I've been accessing that. You're almost accessing onshore those Chinese unicorns onshore in China, that without buying individually names, but without restricted with quota, so on and so forth, and to invest in that fund, that would be quite a way to
Yeah,
access.
yeah, and I definitely think, yeah, there's a lot of talk about small cap China outperforming, and historically, a lot of people would play that through a CSI 1000, but I think K-Star is very interesting in comparison. If you run that comparison chart, could be really interesting to take a look there.
Yeah, and I like the point that you mentioned early on that even though we had a good year of 2025, now this year is starting with looking stable and proceeding ahead. This is not the asset class that is overrun in any source whatsoever. I mean, you may in the investment committee discussing where should we take some profits from last year's gains. This is definitely not the asset class. It's too early. It's way too early. You haven't really capitalized that. I remember one of the slides you mentioned on early on with all these asset class are there at all-time high. You may see Nasdaq 2% away from it. You may see EM 2% away from it, and then you see KWEB is still massive way to run. So I say all these people who delve into our regular quarterly webinar follows your CLN or follows our fund really closely. This is not the moment to say, you know what, done the job. Not at all. So please stay invested, hold on tight. There's more good news to come for this fund to continue to run. Brandon, we have a feedback. This is your CLN readers give you a feedback to say, can you add to your CLN some information on coming events which may impact the Chinese stock markets, government policy changes, IPO, etc., etc., etc. I think this, I'll leave it to you to decide. You're the author, but a good point to
Yeah,
say.
yeah, definitely. Listen, we don't write this for our consumption. We write it for our audience, and I definitely think one of the issues with news is it's always backward looking, and we really want to prepare investors for, you've got in the two sessions coming up in March where this draft will get ratified, and we'll then really start to see much more explicit policies articulated around supporting that domestic consumption, that AI. What are the real policies? We're seeing that happen. But yeah, that's a great suggestion. And please, like always, don't hesitate, to suggestions, critiques. I'm thick-skinned. I can take it. Please, yeah, we're open for feedback.
We also have one question from David from Morgan Stanley. He asking if we have any, stocks exposures or sector exposures of high performance data center stocks like GDS or VNet. And then, he was saying Morgan Stanley is very bullish on those specific names.
Yeah, yeah, that's a great question, and yeah, thank you, David. Yeah, and Morgan Stanley. Um, they just put out a piece on their favorite parts of and I mean, I was just like, wow, this is literally like the top 10 at KWEB. I mean, that was just it was, oh, for AI, here's the cloud names, Alibaba, Baidu, Tencent. There's a whole, it was blanking on his last. Gary is the Morgan Stanley internet analyst, but I'll try to track down that piece, David, and make sure you see it. But yeah, historically we have owned those names within KWEB. KWEB does have a minimum market cap and trading liquidity screen, and so those names fell below those thresholds. That KWEB is the largest China ETF here in the United States. I like to argue it's the largest China ETF outside of the United States that's explicitly compliant with U.S. executive orders and CFIUS. That not I know Jialin, there's a number of ETFs in Europe that, wow, I'm just a little surprised by some of the names they hold. But
Some
uh,
of the funds still holds the executive order names, which to us is also surprising to do that. But I guess just this is something to remind yourself to does look through the funds you hold. I mean, just cautious on time, Brandon. Maybe we'll take
sure.
another question, and I'd like to answer this one to the audience. I hope you still hear. You asked, didn't give a name, but I hope you still hear We obviously presented our case. This is where we monitor the market day in, day out. This is where we see the policy stance are. This is what we see the valuation are. This is how we see each of the company doing. Obviously, the audience is asking. We have presented the catalyst, the reasons, and the positive side of this asset class, and he'd be interested to hear, he or she, I apologize, be interested to hear if we have any concerns or the other side of the coin. Was there anything that you want to share?
So this is more on the potential risks.
Mm-hmm.
So yeah, it's a good, and it's certainly something that we want to provide this balanced perspective. I mean, listen, the risks, the negative narrative is every day you read the Wall Street Journal, every day that you read Bloomberg News or the Financial Times. It's just the media is just perpetually negative. 60 Minutes. But I think, yeah, the risk that I think about, Xiaolin,
Mm.
we've had a lot of IPOs in Hong Kong, and obviously that's a good thing. This is the animal spirits of capital markets returning, but more
Mm-hmm.
supply. If we keep demand constant, means prices
Yeah.
go down. Where do
Mm.
I fund a new IPO? I might have to sell what I already own. So I think well, it's great times to be a trading desk and an investment banker in Hong Kong.
Mm-hmm.
This rush to IPO, I'd rather see that done in a little bit more of a systematic manner. That might be wishful thinking. I think that's an issue we continue to monitor.
Agree.
I think
Probably policy. I mean, is at the end of the day, policy matters a lot for this country. You name the field that what they've done during pandemic, which lessons learned in the hard way. So far, they have says or saying they're going to be very accommodative in policy. We have been monitoring that. The policy bazooka happened in 2024. Now it's like nearly a year and a half now. They have been keeping their promise to be very accommodating in policy. And like you mentioned, NPC, the National People's Congress, is happening in March, just a matter of months and a half away. We need to watch for that policy. But so far, what we can read, we can confirm, is they continue to be policy. Policy is something to watch on.
Yeah, China's government is a large bureaucracy, and policies get distilled and pushed down. And I think that's where we saw Trip.com, that they're being investigated by the State Administration of Market Regulation. The market is so scarred from the regulation from a few years ago that the stock was immediately, investors shot first before asking questions. I think the timing of that investigation, it's really too bad that you finally have people coming back, and Trip is a very well-respected, well-run company. Hopefully, it's whether or not them were pressuring hotels to keep prices
Mm,
down, I don't know. But I just think the timing is too bad. PDD, they've $45 billion of market cap lost since November 10th.
mm.
And
For
uh,
a fine of how much?
the fine of 100,000, $14,000.
Okay.
So it just shows people are on eggshells, and so sometimes this bureaucracy, it doesn't know what one hand, and I think top down to it's try there's so much stability in China that anything they should try to not to rock that boat as people come back for this
Mm,
re-rating. So that policy error issue is always out there. Xiaolin, people say, "Oh, what about Taiwan?" But again, China favors stability, not instability, and so I really, we're really, really don't not believers in, that China will play it cool. It's been 77 years that China didn't, invade So
Mm.
that's 28,105 days that China's not done a military, and I think some of these issues, yeah, they're you know yeah they're yeah, if we just think about it pragmatically, it just doesn't, just through that
Yeah.
lens of stability, it doesn't make sense. So then, obviously we're headed into Q4 earnings, so hopefully those earnings really live
Yeah.
up to expectations. That's obviously yeah, critical.
Any expectations on Q4 earnings? What you watching and what you watching very closely? Want to share with the audience? Obviously, it's a preview of your CLN.
I think e-commerce, we've seen this restaurant delivery war really weigh on the bottom line of JD and Meituan. So I'm
Mm,
looking for guidance from the companies that we've seen a little bit of the regulators stepping in to address this race to zero. And maybe we get a little guidance, is the government applying pressure for them to back off? That would really help the bottom line. Certainly for Alibaba, on e-commerce, looks like tepid growth. Can cloud, make up for that?
mm,
Expectations 35 to 40% revenue growth for Q4 cloud. That's a nice bar.
yeah.
Baidu, do we get further? Where are we with the AI chip unit spin-off? How is their AI, their robo-taxi unit doing very, very well?
Mm,
10 cent, yeah, I'm just shocked that, 10 cents not performed better. Such a really, really exceptionally well-run company.
yeah.
Uh, such a I mean their buyback is just unbelievable. They should be getting at the Milan Olympics they should give 10 cent a gold medal for their buyback. So anyway, but then then I think some of the exciting names, Bilibili, Quashu, 10 Cent Music, some of these online video companies, can they live up to the expectations? So a lot going on there.
Mm.
In terms of Q4 earnings, which we're just not too far away from.
Exactly. Last bit is a bit of self-serving serving announcements. You coming to Europe, do your usual Chinese New Year lunches with clients in Italy, clients in London. We have sent out the invitation, and for those we may miss you, if you want to you want to attend, reach out to the team in Europe. We get that organized. That's all we have the time for today, Brandon.
Yeah, this is great, Jalen. I mean, and certainly again, if you want the deck, email us at info@kraneshares.com. If you have a question, please don't hesitate to reach out anytime.